All right, today we're digging into Paycom. And for more than a decade, this company was the absolute definition of a Wall Street darling. I mean, they were this huge innovator in HR software, and their growth story, it was just incredible. Investors absolutely loved them. But, well, the music seems to have stopped.
So that brings us right to the heart of the matter, doesn't it? Is Paycom's golden age actually over? I mean, this is the question on every investor's mind right now. Because that meteoric rise we just talked about, it's hit a massive speed bump. And now everyone's wondering, are the best days for Paycom in the rearview mirror? And wow, this really puts it into perspective. Just look at the difference. On one side, you've got the past. That's the rocket ship, right? Consistent, staggering growth of over 30%. And then you look at the present, and it's a completely different story, a slowdown to around 11%. So the big mystery we need to solve is, what happened in between? Okay, so to really get what's happening now, we have to rewind a bit. Let's break down the winning formula, the anatomy of what made Paycom such a Wall Street darling for so long. Paycom's rise was really a textbook example of smart strategic moves. They started way back in '98 as one of the very first companies to put payroll online. Then, pretty quickly, they expanded into a full HR suite. The IPO in 2014, that just poured gasoline on the fire. But the real game changer, that came in 2021 with the launch of Beatty. This self-service payroll system was huge, and it absolutely cemented the reputation as a top innovator. So what was their secret sauce? It really boils down to these key strengths. It wasn't just one thing, but how they all worked together. Their number one advantage, for sure, was this unified all-in-one platform, everything built on a single database. Now, this is crucial, because a lot of their competitors just bought other companies and stitched the software together. With Paycom, it was all built from the ground up, so it just worked. Add in the fact that it's been founder-led since day one, and you get a product that customers just don't want to leave. It's incredibly sticky. And if you need financial proof of how powerful that model is, well, here it is. 85%. That's their gross profit margin, and it's been incredibly consistent. I mean, that is just a jaw-dropping number. It's not just high, it's a sign of a fundamentally healthy, efficient business. It's basically a cash machine. And a huge part of that stability comes from this right here. Take a look at this breakdown. Almost everything, we're talking over 90% of their revenue, is from recurring subscription fees. That gives them insane predictability. They're not out there hunting for a big sale every quarter. Nope. They're building a fortress of sticky, long-term customer relationships. Okay, but that was then. That was the story of their unstoppable rise. Now let's pivot to today, because we're entering a totally new chapter, a new battleground, where some cracks are definitely starting to show in that shiny armor.
Yikes. I mean, this chart, it really speaks for itself, doesn't it? You don't need to be a Wall Street analyst to see which direction this trend is going. This isn't just a little blip on the radar. It's a very clear pattern of deceleration. That high-powered growth engine is, without a doubt, cooling off.
So what's behind this slowdown? Well, the main culprit is this. The competition has gotten fierce. The playground that Paycom used to have almost to itself, it's gotten really, really crowded. And they're not just fighting on one front. They're getting squeezed from all sides. You've got the legacy giants, the incumbents like ADP and Paychex, who've gotten a lot better. Then you have direct cloud competitors like Paylocity and Paycor, who are going after the exact same slice of the pie. And to top it all off, you have the big enterprise players like Workday coming down from the high end. It's a tough spot to be in. And this quote, this really hits the nail on the head. This is the core of the bear case against Paycom. See, they've always charged a premium price because they had a premium superior product. But what happens if that product advantage starts to shrink? Well, that premium price tag can go from being a sign of quality to being a major weakness really fast. Okay, so faced with all these challenges, what's the plan? How is leadership responding? Well, they're not just sitting on their hands. They see what's happening, and they're rolling out a whole new playbook for this next chapter. And that new game plan really has 3 core pillars. First, they're trying to move upmarket and land bigger, more enterprise-level clients. Second, they're leaning heavily into AI and automation to keep their operations efficient and protect those fantastic margins we talked about. And third, and this is a huge shift, they're starting to give cash back to shareholders. So if we put together a little scorecard for management, you can see it's mostly strong marks all around. Strategic vision? Strong. Innovation? Strong. I mean, these are the folks who built this amazing company. But your eye probably goes right where mine did, that fair rating for governance. This is mostly about things like the founder being both CEO and chairman of the board. Now, that's not necessarily a red flag, but for an investor who's already a little nervous, it's something you can't ignore.
That last point about returning cash is tied to something called capital allocation, which is really just a fancy term for how a company spends its money. And for Paycom, this is a massive signal. For its entire life, pretty much every spare dollar was reinvested back into the business to fuel more growth. By starting to pay dividends and buy back stock, management is sending a very clear message. The hyper-growth chapter is closing. We're a mature company now. This isn't just a small shift, it's a change in the company's DNA. Okay, so we've looked at the amazing history and the much tougher present. Let's put it all together and get to the bottom line. What's the final verdict for an investor looking at Paycom today?
And really, it comes down to this classic bull versus bear debate. The bulls, the optimists, they're going to look at the left side of the screen and point to those incredible margins, the super sticky customer base, and a management team that's proven they can win. But the bears, the pessimists, they just can't get past what's on the right. The undeniable slowdown, the brutal competition, and a market that's getting pretty saturated.
And this quote from the analysis really just says it all. Paycom is a high-quality business. No one is debating that. But, and this is the key distinction for any investor, is a great business the same thing as a great investment right now? The verdict seems to be not yet. The jury's still out. The pressure is really on Paycom now to prove that the old magic is still there. So if you're keeping Paycom on your watch list, what are the signs that might change this wait-and-see verdict to a buy? Well, you'd want to see revenue growth start to climb back up, maybe into that mid-teens range. You'd want to see a genuine breakthrough into a new area like international markets. You need to see some real proof that their competitive mode, their advantage over rivals, is getting wider, not narrower. And hey, a cheaper price tag would certainly help too. And so, this is the question we're left with. Nobody's arguing that Paycom isn't a good company. It is. It's a high-quality business. But for a decade, it wasn't just good. It was exceptional. And the billion-dollar question for management and for any investor is, can it be exceptional again?